So there are two things that can be done. One is that you can tie the investments, the outside investments, to the value of assets held by the co-op. So to go back to the gold making or the widget making co-op that had as a supply of gold, if the value of that gold goes up, there's no labor contribution to that capital gain. That's just purely due to market fluctuations in the price of the assets. Those earnings or losses don't necessarily have to be appropriated by the members of the co-op, by the workers. Those could be shifted to the outside investors. And in some cases that might be useful to do for, say, all the assets of the co-op or a certain subset of those assets. Now, those investments, which I'm generically calling a co-op asset-backed security because they're represented by real assets, would pay a fixed return based on the current value of those assets. So if the co-op bought some assets and those increased in value, the interest payments would scale with that increase in value to the investors. They wouldn't carry any government control. And if there were sort of maintenance or depreciation costs for those assets, those would also be borne by the members because that's an operating expense and created by the use of those assets, which is the responsibility of the members, not the investors. So the main idea is that we can pass through these capital gains to the investors without violating any of the worker co-op principles. There's also a time horizon problem where sort of older members or members that are preparing to depart have less incentive to invest in fixed assets. One of the issues, and there are a number of issues, sort of time horizon issues, is that if the asset is being financed with debt, this debt has, in the beginning, at least a high interest expense. That's a loss or a reduction in earnings that the member bears, and then they don't see the benefit of owning the asset later after they've left the co-op. The second issue is that if you buy a large asset, that reduces the liquidity of the co-op, and you may have trouble paying out the internal capital account when the member leaves. So one possible solution is that normally it's implied or explicit that when a member leaves the co-op, their investment will be monetized or paid out over a short period of time. As an alternative, it could be converted to preferred equity, perpetual debt, or some co-op asset-backed security, which would be the slowest payout over time possible, as opposed to a quick payout, which forces the co-op to draw down its assets. So, what are the things that we're really trying to do? These are suggestions to make the liabilities predictable so that they're independent of the earnings history of the co-op, that they're independent of member departure, largely. It would be nice to have discretionary payments with preferred equity, of course, as opposed to debt, which is difficult in practice. But if you want to remove the collective reserve account, that's something in practice you probably need if you're getting rid of that insurance function. We're also trying to create a robustness to asset price shocks, and that would sort of facilitate large capital-intensive co-ops, which are very difficult now for those reasons in addition to the general capital-raising reasons. And the idea is that the co-ops, in a sense, would like to set asset targets in terms of member investment, where the level of the total level of member investments is more of a sort of set goal as opposed to something dictated by the buy-in and the profit history. So one way to do it is to sort of set it as a percentage of the total assets, or to set it to be able to absorb a certain period of loss or level of loss. And these things I don't think are really looked at actively by co-op members. It's just more of we're going to have this. We want we want this portion retained for this period of time, and it seems in practice the co-ops aren't really thinking about it in that way per se. Or the other way to target the assets is to have a desired level of interest payments to outside investors, or total payments, or an interest rate, by managing the level of co-op investments. And that could mean in certain periods, if it's below that level, pulling all the earnings back into the co-op for reinvestment, or if there are too many assets to pay out most of the earnings, but to do it in a more sort of intentional way, as opposed to have just some rules which dictate these things. Are there questions? Comments?
I have questions.
Go for it.
So tell me about demutualization.
So generally demutualization is something that you don't want to happen, and it's when a co-op effectively sells itself and converts to a conventional business.
Oh, okay.
And the idea, generally it's sort of the thing you don't want to happen, because you lose the worker ownership and you lose the democratic management. But in practice, there's always a financial incentive for members to demutualize, because in the co-op model, the members are entitled to the value of their investments, basically their portion of the net asset value. Whereas under the conventional business valuation, the business is worth the discounted value of all future profits, and that's always higher than the net asset value for a profitable business. And this is the main difference. And that extra value is considered goodwill, and it's not actually a current asset, it's an anticipated asset from these future profits, which will then be appropriated by the owners and not the members.
So in demutualization, that is taken into account on the price tag? You're not just selling the assets, you're selling the name and the brand and whatever future profits are.
Exactly.
So that could cover whatever payouts you have as liabilities for past members that haven't been paid out?
So it would generally cover that and more. So typically if...
And would those who have left be allowed to have a share of the more part, or is it just those who are currently in the co-op selling it?
Typically the current members, aside from some accounting where if there's a collective reserve account and they track who's contributed to it, if you demutualize, in theory they should be paid back according to their contribution. But the main issue is that if you just stopped a worker co-op and sold all the assets, each member would basically get back their investment, which was their internal capital account, because that is the value of the assets of the co-op, or the net asset value.
But the goodwill part?
There is no goodwill in the co-op. So the big distinction is that in a co-op, the net asset value is the market value. There are no intangible assets.
Why would somebody buy a business if they didn't expect to make profits in the future?
We don't want them to buy worker co-ops.
But, but I'm saying
yes.
It's happened.
So if you
it's
convert
not like a
right.
theoretical situation.
So
it's happened.
if you convert it to a conventional business and then own that business, then you are entitled to all those future profits. And that's the difference. Whereas in a worker co-op, those future profits belong to the future members at that time, who appropriate those profits by right of their membership. In a conventional business, you're saying those are no longer members, they're employees, they have no rights to profit or to control their business. But that goodwill can be realized in the present through the demutualization process.
Is there a mechanism for solving this kind of like incentive perversion problem, where you can maintain the fairness or the justness of running a co-op, but I guess the thing that would exacerbate this problem the most would be, imagine some business that's like a research and development business that's developing nuclear fusion or something, and at the end of 10 years they finally figure it out and they have nuclear fusion, and so all the money would be made by the people who are in the co-op at that time. And if it was, if the business was the primary innovations that allowed it to exist happened in year 8, and from the hard work of a bunch of people in it who then leave, all the money then goes to people who didn't deliver the value for it, and so it creates this weird problem. Is
Yes.
there a way to make it so that people are rewarded in proportion to the value of the work that they do within the co-op?
Let me try to address this with the next slide on startups. So basically what you explained is the issue with startups where there's a period of losses, expected losses, before a co-op becomes profitable. And the question is, how do we deal with these losses when there might be this shift of members or of income from the profitable period back to the previous period when there were no profits and where the members were in fact appropriating those losses. There's two current ways which this is done now. One is with a negative equity account. So what you do is you sweep all the losses into this negative equity account, and later you credit that account with profits until a zero balance is reached, and then you sort of call it even, and then the profits go to the members as they normally would. And this basically has the effect of not having the internal capital accounts drawn down at the beginning. So there's some protection there. The other thing they do is you sort of capitalize the startup cost. And according to sort of generally accepted accounting principles, you try to match the cost to the sort of the period when they happen, as opposed to sort of the strict accrual accounting where you record the expenses when they take place. So if there was a startup cost, say $1 million, what you would do is you would amortize that over, say, a 15-year period, and sort of write it down so that the first initial founding members didn't bear that entire loss. And so those are the sort of two ways they're done, and they don't really address what you were getting at either. You have comments?
Not yet.
No. But so, and I will try to address that in a second. But what's happening with those two things, where you're either creating this negative equity account, which negative equity is obviously a myth, it doesn't actually exist, and a capitalized expense is not really an asset also. It's merely there for accounting purposes. But these basically pretend that the members aren't bearing the losses. So under these two models, the internal capital accounts stay constant in value, and it's as if there were no investment losses for the members, which I would argue are actually occurring. And there's two problems with this. One is that if a member leaves the business, they're transferring their share of the loss to the remaining members, who may or may not offset that with profit in the future. And two, if the internal capital accounts are paying interest, they're paying interest on an artificially high value, but the assets really aren't actually there. So one of the things that's done to sort of offset the difference and the reduced wages is that you pay a difference. Is one of the things I think Arizmendi does, is you pay a wage bonus based on the difference after profitability and the original wage, so that if people are now making $15 an hour before they're making $10 an hour, you give the founding members a $5 an hour bonus for the time they were making those reduced wages. But this also ignores the investment loss. And I think this sort of comes to the core of what it means to be a co-op and what it means to sort of be a conventional business. And it's something that I think worker cooperative community hasn't really addressed in a concrete way. So go ahead.
By investment, are you talking about capital investment or sweat equity? What kind of investment?
I'm talking about a capital investment. So it's usually said that the members of a co-op wear three hats. They're the owners, as in they appropriate the profits or losses. They're the managers, and they're the laborers, the workers. I would argue there's also a fourth hat, which is somewhat ignored, is that they're also investors. And they're investors in this funny way where if they're a founding member, they're expected to make an investment that's going to decline in value. And this is something that's unprecedented in the sort of mainstream financial world because of the idea of goodwill. So if you have a conventional startup, you can have a business that's losing money over time, but so long as the future expected profits are increasing, the market value of that business goes up. So you could have a sort of conventional startup whose market value is increasing continuously in time despite operating losses. So the mainstream finance doesn't have to deal with this issue of investments declining in value. The worker co-op community does have to do this, because if there are losses, there's only one party that can appropriate those losses, and that's the members. And if there are losses, that means the member investments are declining in value. And that's something that's sort of glossed over, and people wave their hands, and they create negative equity accounts or these capitalized loss schemes, and don't really address. So, you have another question.
Do you have a drawing of this, a flow chart?
Yes, but it's not in this presentation.